Testing, 1, 2, 3. Hopefully you guys can hear me at this point. I understand that we are having some sound problems. I'm going to wait. So if somebody who's watching can just confirm, are you getting any sound? If you are, give me a thumbs up or say sound okay so that we know you're getting some audio. All right, good. All right. So the American people have spoken. Donald J. Trump is the president-elect. He'll be the 47th president of the United States. I had previously said on this live stream that the markets were pricing in a Trump victory. I said that because many things that were indicative of a Trump trade had rallied significantly going into the election. At the same time, some things that might have faced some potential headwinds if he won, based on talk about things like tariffs, for example, had begun to show a little bit of weakness. So I'm talking about FXI, KWEB, CWEB, which includes a lot of stocks, which, by the way, I happen to think were quite reasonably valued. But it is amply clear from today's performance that there was more uncertainty coming in than I had expected there was, and that his election is widely viewed to be a meaningful positive for U.S. stock prices. Let's talk a little bit about a couple of the things that made this more positive than it otherwise would have been. I think one of those things is the fact that he essentially won all of the swing states. The victory was a fairly decisive one. He won the popular vote. And what that did was it eliminated some of the uncertainty that was baked into the possibility that the election would, be a long drawn out affair and that we wouldn't know right away and that there might be legal actions and things of that sort. But I think it's very clear now that we have a concession. Kamala Harris has made that phone call. He won the popular. He won the Electoral College. And quite convincingly at that. Couple things that I think are a little bit interesting here, some that caught me a little bit by surprise. We can talk about a couple of those things. First things first. On Monday, we were talking about energy. Energy, like almost everything else, had a very big day. But now that he has won, I think we can be a little bit more specific about the area of energy that I think could potentially do very well here, and that's going to be something like oil services. The reason I suggest that is because if you think about what's going on, if we are more aggressive with our fossil fuel policy in terms of production, then if you think about the integrated oil companies or businesses that essentially whose assets and whose income are a function of the price of oil, that's one thing, versus the companies that are going to benefit from the investment to develop more reserves. And that's going to be the services side. And you'll notice that if you take a look at the entire sector, I don't know if you can see this. So this is everything in the energy complex here. And this first one is going to be the energy, the gas equipment and services component, right? So that's the part that is up most significantly, up almost 9% today. And if we take a look, that's going to include the biggest oil services company, Schlumberger, and Halliburton, which people who followed me will know that I've, for a couple of reasons, I've often looked. Halliburton has a lot of exposure to onshore. I think that one of the things we are seeing is that there's some expectation that offshore is probably going to catch a little bit more attention. But the reason I wanted to bring these stocks up, even though they've had such big pronounced bounces today, is because I wanted to show where we are in the context of history with the oil services index. So as it happens, for anybody who doesn't know, just a little bit of my own personal history, this is actually where I began my career, was trading the oil services index. So before there were ETFs in the late 1990s, there were a sector-based cash-settled indices, and the Philadelphia Stock Exchange was the exchange that in particular focused on these things. So there was the bank index down there, there was the oil service index, and I was an oil service index options trader. We also happen to be specialists in a number of oil service company single stocks as well. So Halliburton was one. I think Cooper Cameron we had in the mix as well. Camco, which there was an acquisition that took place. It was, I'm gonna, we're going back some ways, so it was probably 1998. I can still remember. It was just a wild day. I was not the specialist in it, but we had a takeover take place in that. But I wanted to show this longer term chart of the oil services index because I wanted to give some sense of the fact that this has actually basically been dead money now for a couple of years. So if we go back here, we can see that the oil services index was essentially at the exact same level that it was in early June. Now, I am hopeful that it is not simply going to be a focus on trying to get energy prices down, although I know that politically that's the most appealing thing to do. As I previously said on Monday, we should and need to refill the Strategic Petroleum Reserve. If we essentially fast track the permitting process and so on, that could be good. So what I'm basically saying is this, and that is that I think that even though we got a big pop today in names like Halliburton right here and in Schlumberger, I actually think that these companies, particularly if they break out of their 150, that these potentially have more potential upside. So both, oops, did I put that in the right spot? Okay, here we are, Schlumberger. So basically the same thing here. And these are not companies that are overwhelmingly expensive, relative to their own history. So we can see, for example, Schlumberger, the thing's trading 12 times or whatever, 11 times, 11, 12 times its forward earnings estimates. In the case of Halliburton, it's going to probably be something vaguely similar. Actually, it's trading in the high single digits here. And as they increase the permitting process, that's going to be good for them. Just remember that Halliburton does have more exposure to North American shale. And that isn't the strongest area right now, for what it's worth. So, maybe you can start also taking a look at some offshore drilling and things like that. But, to me, the backdrop is the right one for them. That is that, they're going to be encouraging maximizing North American oil production. And if you are an oil service company, in theory, you should benefit from that. Okay, other things. Folks will know that my acronym at the beginning of the year, BRAVE, Bitcoin, real estate, AU with periodic symbol for gold. I said, I think within the last week or two, that I had not changed my view on these things. I still have not. So here's something that and actually we've also talked about treasuries, because we also have referred to the fact that we thought that there was probably some risk that long-term rates were going to continue to rise regardless of who won. I spoke recently about the fact that even if Kamala had won, this was from the University of Pennsylvania's work, they figured that there was incremental $1.2 trillion of debt not adjusting for economic growth impacts related to her economic proposals, in as much as we had any, really. The net debt effect was expected to be about $2 trillion for her, $3.2 trillion for Trump. So the expectation is that the aggregate level of debt would grow about 30% more, let's say, over a 10-year plan, a 10-year period, if you took Trump's proposals as they were articulated and simply extrapolated that through versus Kamala's. In either case, you would expect that long-term rates could potentially go higher. They did. The 10-year rate is up about 20 basis points today. I'm showing a chart of TLT. TLT, of course, is the 20-plus year Treasury bond ETF, so even more duration here. This is the one that got particularly hard hit when rates started to rise. The last time, in fact, TLT fell peak to trough by more than 50%. I am not expecting anything close to that kind of a decline this time around, partially because it's almost mathematically impossible. Remember that when TLT topped out, if we go back in time, the 10-year Treasury rate had gotten down to about 68 basis points. So if we look back here, rates were, and actually I can probably add that. So let me just put that in so we can take a look at the 10-year rate. So we get some sense of what the starting point is, right? So yeah, we can see that this was essentially the lows, and that was, wow, this was 50. Yeah, it was actually less than 60 basis points. We were in the 50s. So essentially the 10-year rate was getting close to zero. We're nowhere close to that now. Convexity is going to be higher when the rates are lower. But if we take a look at long-term 10-year rates, and I'm going to go as long as I can here, we can get a sense that even though we've seen this big, sharp increase, and that in the context of recent history, it feels very high, it isn't that high from a long-term historical context. So I'm just going to throw a line where we are right now and go back to 1960. So here's where we are, where the white line is. And you can see, actually, that the 10-year rates really have only been lower than this since the GFC, right? Since the Great Financial Crisis. We have normalized these rates as if this is the way things are, but the truth is it's not the way they are. It's a very abnormal condition. Now, there's a guy on the SIBO. He's a vol trader on the rate side, and I happened to see Rick Santelli talking to him earlier today. I was on CNBC around 2 o'clock this afternoon, and shortly before I came on, Rick was talking to Sem Carson on the SIBO. Sem was suggesting that the long rates might not go up as high, and the reason he believed that was going to be true was because he said that they were going to start QE again. And let me just, I'm not so sure about that. I don't think that's I don't think that's a good idea. And let's just take a look at the Fed's balance sheet. So even as a lot of people were talking about rising rates, there was a period of time when the Fed was still meaningfully adding to their balance sheet, but they have been letting things peel off more recently. That's here. So this is the Fed's balance sheet, and we can see that basically it's been trending downwards. This is a good thing, right? We want to have a more normal, effectively the way you can think about this is all the money that was printed as a part of quantitative easing since the GFC. So we had a note how steady the increase in the Fed's balance sheet was until Ben Bernanke decided, hey, we can just start printing money. That took place in the GFC. Before that, it grew very steadily, and it grew approximately in step with the pace of growth in the US economy. So that was okay, right? So if you can imagine that if the amount of goods and services available to consumers is continuously increasing, and the aggregate of the money supply is growing at a comparable rate, then you are going to be managing your inflation rather well. Now, when QE first took place, it'll probably surprise some of you to learn that I wasn't completely opposed to it as a policy prescription at the time. Why is that? Because obviously I'm not in favor of money printing, and I'm not in favor of QE generally. But why would it be that I would be okay with it at that time? I think we were at a very risky juncture. First of all, we needed liquidity. We needed to be able to find liquidity for debt for which there was no market, and the Fed provided that market. The other thing is that when you had that debt bubble collapse, essentially money is created, of course. You print dollars. The Treasury could actually print out paper money, and that would be one way you can do it. You can create money, the Federal Reserve, by creating credits and distributing that to member banks in the form of quantitative easing and buying those purchases. That's another way to create money. But of course, the banking system itself also creates money. $100 goes in, $80 gets lent out, spent, $60 goes in, $50 gets lent out, and so on. So there is a multiplier and a money creation effect that occurs, and that essentially got eviscerated in the GFC. And what Bernanke's Federal Reserve was trying to do was essentially mitigate that gap. And in fact, my friend and colleague, Professor Mark Guthner at Rutgers, who co-authored The Options Edge, who we have on here sometimes. He actually did an analysis, and essentially he saw that the asset purchases were basically a clean offset. And what it did was it just steadied out the money supply. And if you steady out the money supply at a time of significant distress, consumer concerns, I think that was a wise course. I wish that what they had done thereafter was sort of normalize the balance sheet more rapidly as things came back. It's not the way it happened, but that is what it is. The more recent efforts, though, during the pandemic, there were many policy mistakes that were made. I think some people would argue that there were policy mistakes associated with closing the government, and maybe extended government closures actually contributed to the result we saw in this election. Some pundits have suggested it, but I think that was a mistake. So pairing the long and all of these assets, I think, is a good idea. Why do I bring this up? Because if they continue on this policy path, which is what I hope they do, then the steepener trade remains in effect. If they do what Sem Carson is suggesting they will do, which is implement QE again and start buying longer dated treasuries, because that's how the Fed controls the rates, right? So they can set rate policy on the short end, but on the long end, that has to be controlled essentially by market forces, and they're the biggest force in the market. So they could simply start buying up create a never-ending bid for long-dated treasuries, and they can set rates wherever they want. But that's essentially how that can get manipulated. There has been conversation that Donald Trump, if he wants to stimulate the economy, is going to want borrowing costs to drop, and that's not just going to be the overnight rate, right? So I don't think the Fed's they're not beholden, obviously, to the executive or to the legislative branches of government, but if we do see some asset purchasing, that's the thing to keep your eye on. So listen to Fed policy fairly carefully. But I will say, in the absence of that, and assuming Sem Carson is wrong, and he's a very smart guy, so I think it's to be balanced. I have to just articulate that there are some people who think this is going to happen. That would stabilize long-dated treasuries, and that would halt the increase in long rates. But again, long rates are not in an extraordinary spot right now. They could go higher, and things would not be crazy. This is the end of the Clinton presidency, for example, and we can see that rates were about 1.6% higher in the 10-year at that time. And I think most people would agree that a good percentage of his presidency represented a fairly healthy economic environment in the United States. So just going to offer that. Okay, so we like oil services. I mentioned Halliburton, Schlumberger. Halliburton, more onshore exposure. Steepener trade. Been talking about it for a while. Not reversing course on that. If anything, going to sort of stay with that. Okay, so let's start taking some questions. Alex S. Hi, Mike. I bought some Jan 17 550.30 Delta puts yesterday. It's now 15. Yeah, any puts you bought, those deltas are going to be lower because this is one of the most extraordinary days I think I've ever seen. Oh, yeah. Okay, I'm going to get back to your questions. One thing I think is rather interesting was the response of the money center banks. JP Morgan up 10% and so on. So I wanted to issue some caution here. So look, up 11.6% JP Morgan today. So another one that really, really rallied. And I know I've been kind of framing a lot of trades as, like this, hate that, or love this, okay on that, pairs trades, that kind of thing, good, better, best, poor in the space. So check this out. I think this was kind of interesting. One of the first observations I made. Not as much now. So at one point, JP Morgan was up 10%, and Bank of America was up about 8.5%. And these banks should not be going up by the same amount. Bank of America has a huge HTM book, held to maturity securities book, relatively long dated, 7 to 8 duration. So their balance sheet, so they can benefit from the things that benefit banks generally, but their balance sheet is not benefiting if long rates continue to rise, right? So the reason I had to bounce back to this is because we just had a conversation about rates. I'm just issuing a word of caution on this one. Okay. One other thing I thought was kind of interesting is check out these two. So Morgan Stanley, this thing went up more than the market did. It is largely an asset manager, right? So it's up 10% ish. I think that's what it was when I was looking at 11.7. I mean, I couldn't keep up with this. Everything was ripping so hard today. Morgan Stanley is basically an asset manager. So, the higher asset prices go, the higher their revenues go. So I thought it was kind of interesting that they rallied more than the broad market. But look what didn't rally as much as they did. I'm going to get back to your questions, just things that I was observing throughout the day that really struck me. BlackRock up 1.5%. Morgan Stanley's up 11.5%. BlackRock's up 1.5%. They're both enormous asset managers. Both of them take their fees off of the asset prices. I was asking around today and I said, what gives? Why does that make sense? Why would Morgan have gone up so much and BlackRock gone up so relatively little? One explanation that was given to me was, BlackRock had supported a lot of ESG and sort of more woke this, that, and the other, and maybe they're paying a price for that. I don't buy that. Honestly, I don't think that people are going to be out there trying to take it out on one of the world's largest asset managers. And besides which, you don't pivot from their ETFs. I mean, the people that are buying BlackRock ETFs, that's not really one of the big considerations. So it just happened to occur to me that, if you're looking for something that, if you're looking for the trade to continue or whatever, and something that didn't rip quite as much, this thing underperformed by 10% today. So arguably there might be an opportunity there. Just something to think about. Okay, so I'm now going to get back to this other thing. So Jan 17, 550 put, 330 30 delta. Should I hold on to it since I have plenty of time left, 72 days to expiration, or roll up to 30 delta again if I want to hedge? Okay, so I mean, the question now, I guess, would be hedge against what? The real hedge that I think most people were thinking about coming into this was that the election was going to create some kind of material disruption. And, as I said on Monday, the thing that we wanted more than anything was a definitive outcome, preferably one where I will tell you that when I was watching the election results last night, I live in California, so, Kamala was definitely going to win this state. No question about that. My biggest concern was, will the Democrats take over the Senate and eliminate the filibuster? So the filibuster, to me, is that circuit breaker of sorts in the political process that forces some form of compromise. And I was concerned about that going away because both Kamala Harris and Chuck Schumer had said they wanted to eliminate the filibuster. I'm going to go out on a limb here and suggest Chuck Schumer doesn't feel that way anymore. He may have felt that way 2 days ago. He doesn't feel that way now. So I think the filibuster is probably going to remain intact. And in fact, I mean, consider this. I believe it was Joe Manchin who said that he could not vote for Kamala on the basis of eliminating the filibuster alone because he thought it was that big a threat. So I think, we're now in a spot where we're going to have to see how it goes. But hopefully the tone, the vitriolic tone of the rhetoric comes in a little bit. It would be awesome if some of the pundits out there would admit there was some hyperbole so hysteria doesn't follow. I saw that Mark Cuban, for example, who was a well-known Kamala supporter, he came out and was very gracious in defeat, if you will. I think he had sort of aligned himself very closely with the Kamala team. He was very gracious in defeat. It would be terrific, of course, if the winning side is gracious in victory as well. And both parties are now willing to consider trying to find common cause with their brothers and sisters across the aisle. I don't know if we can count on that. What did he say exactly? So Mark Cuban said, congrats at real Donald Trump. You won fair and square. Congrats to Elon Musk as well. Godspeed. So, and look, I'm not going to say, somebody said, oh, he was a clown. He's acted like a clown going into this. Well, it's an election. People, there's a lot of hyperbole, as I previously said, that gets used. All right, so maybe we can lower the temperature. That would be great. Didn't do it before the election. Maybe we can do it after. One can hope. If we do, then I think that the risks to equity short term aren't crazy. I'm a little upset about valuations. That's really the toughest thing for us right here, is that we're at very heady valuations. So sort of everything kind of has to go perfectly. Steve B says, totally crazy today. Have other elections gotten reactions like this? Well, peak to trough, or more accurately, trough to peak, when Trump won in 2016, it did. So for those who don't remember, the futures sold off very precipitously overnight. Let me see if, I don't know if my futures data goes back that far. Let me see if it does. That would be pretty good. Let's see. I'd actually have to find, I might have to go and find the actual futures symbol. Will it go back that far? It doesn't, unfortunately. So just as a quick reminder, the future, when it became clear that Trump was winning, the futures sold off overnight very sharply, and then they almost immediately rebounded. And then by the end of that month, the market was up about 10%. So if you take a look at the peak to trough move in 2016, then I would say that it was a move not dissimilar to this one. The big difference is, and the reason this one looks so pronounced, is because you didn't get that drop off at first. I think this time the market was kind of pricing in a Trump victory, as we previously said. I'm going to argue that one of the reasons it's rallying more sharply today is because Trump might be viewed as being better prepared. He didn't really have a transition plan before, because I think, I could be wrong about this, I don't think he thought he was going to win the last time. And so that he ended up relying a lot on sort of inside the beltway talent to help him out. Now he is surrounded by people who are in the political sphere or are well known, but are kind of outside the beltway folks. I mean, RFK Jr. obviously comes from one of the most storied political families in U.S. history, but he's widely viewed to be an outsider. Tulsi Gabbard, obviously a well-known politician, was in the hunt for her primary some time ago, now has switched over to the Republican Party. So she's a well-known face, but I think she's viewed largely as an outsider now. Elon Musk, remember, I don't know if anybody remembers the picture of him going into Twitter after he bought it, but he walked in. See if I can find that picture, or if somebody else can. So he walked into the building and he was carrying a sink. Let's see if we can. Here we are. This was the picture, and he was tweeting out similar pictures now. And what they're talking about is Doji. Doji, for those of you who don't know, that's the acronym that he's come up with. Department of Governmental Efficiency, something like that. So he made a point recently that there's something like 450 government agencies, which means that the government's been creating government agencies at a pace of about 2 a year. And his thinking is that he's going to try to look for some massive streamlining. One of the things that he has proposed in this, which I think is very wise, is that he is talking about a prolonged severance. And from the U.S. taxpayer's point of view, this, and when I say prolonged, I'm talking about like a 2-year severance. So if he goes in and he says this department is unnecessary, these employees are unnecessary, we're going to eliminate the whole thing. He's saying, go home, we're going to keep paying you for the next 2 years. Because he thinks that these are jobs that are not really that productive anyway. You're going to pay those salaries if you don't eliminate those jobs. And you're going to have huge pushback, entrenched interests, if you don't make big concessions. It could be a windfall to those employees if they are able to get paid and then go pursue other interests, whether those are entrepreneurial interests, whether they decide to improve themselves, or whether they decide to go and seek other employment. So basically a concession that it's going to be very costly, but it needs to be done. And, a lot of people pay lip service to government efficiency, but few have actually gone into organizations with thousands of employees and managed to radically change essentially the bureaucracy within the organization, and still have it survive. And X, formerly Twitter, is an example. I mean, he laid off, I think, 80% of the staff. I'm not going to say that didn't come without a hiccup or a hitch. And he admitted, he said, look, we got rid of some people we shouldn't have. We hired them back. But that could be pretty profound in terms of enhancing productivity in the United States if we actually tackle government inefficiency in a way that we've never done. That, I have a feeling, is going to be very challenging to do. It's far harder to do than it is to say, even for somebody who has built the world's largest rocket, even for somebody who has bought a publicly traded company for $44 billion, laid off 80% of the staff, and still gotten it to function. But even if some fraction of that work got done, that is a powerful elixir for the U.S. economy. So I think a lot of that has to do with the things that we're seeing in equity prices today. IWM had a big day, overbought 13% over the 200-day moving average. So it's interesting. I think I had mentioned this before when we were talking about the Trump trade, that IWM in particular, which is the Russell 2000, so this is the small caps, that they would be considered bigger beneficiaries of a Trump victory maybe than the ultra large cap companies were. I mean, if you think about a company like Alphabet, for example, kind of an insider company, that wasn't going to be the business that was going to benefit as much as small businesses would. So from a fundamental point of view, it does make some sense that the rally in there would be sharp. And by the way, as big as that rally was, so we were up 5% or so today. Consider that you've got things like JP Morgan up 11.5%, Morgan Stanley up 11.5%. Not that those banks shouldn't trade at 13, 14 times forward earnings, which is essentially where you get. But yeah, I think what happened in the Russell makes some sense. It's a step change in valuation. But I want to also leave us with this following point, which is that as we need to keep valuation in mind, because the higher the price you pay in terms of, the higher the price you pay, the lower your net returns will be, and the bigger the risk you're taking. And on that score, the market's not particularly cheap right here. So max this out so we can get a sense of it. Can it go higher? Sure it can. But just know where we're at. Right there. Okay, so this is now going back 35 years. So 35 years, the average forward PE is 17.9. And we are at 24.2, give or take. And I think we can and should ignore this period right here, because remember what happened. So right in here, earnings absolutely collapsed because everything was shut down. And if earnings collapses, even if the price falls, if earnings goes to zero, then the PE becomes infinite theoretically, right? So, or if it goes negative, it becomes entirely meaningless. So bear in mind that this set of data is really not that representative. So if you discard that and say, okay, going back 30 years, what else do we have that is somewhat similar to what we're seeing now? And that's this period, right around 2000, tech wreck kind of stuff. So that's a little bit discomforting to me. And it might be a reason that, and oh, by the way, I mean, options premiums were highly elevated because everyone was concerned about this, and they've come in quite sharply. So here we are, you can own puts more cheaply, which is fine, and you can roll them up and out to get that delta. As long as you're long deltas on balance. As I say most of the time, I don't favor being short stocks on balance. Over the long run, stock markets go higher. Actually, I saw a phenomenal chart, and I don't know where they got this data, but somebody had a chart out that had essentially stock market prices going back to the late 1700s. And yes, there were stocks that went back that far. The Philadelphia Stock Exchange, where I was once a member, is the oldest stock exchange in the country, and indeed it was founded in the late 1700s, very shortly after the country's founding. So, but what was amazing about that chart, if I can find it, so see if I can find that chart. The amazing thing about it was that it basically just showed that the market will, over the long run, grow out beyond whatever short-term problems you have. It doesn't matter. World War I, World War II, Korean War, the Vietnam War, the Civil War, doesn't get much worse than a civil war. And yet, in the long run, you find your way out of the back end of that. And that is largely because the U.S. economy is a vibrant one. It grows over time, and sometimes not as fast as other times, but that's just the reality. And there's one other thing too, which is that I am also a big believer in technology's capacity to enhance productivity. And we take a lot of things that, for granted that would seem outrageous not that long ago. From the enormous TV on your wall to all. Someone was just saying something about my audio. What was that? Am I losing my audio? You hearing me okay? Okay. So there seems to be some kind of a problem. So Mike, gold sold off hard, yet I think inflation is going to ramp. Do you think this is an opportunity to buy? Look, long gold all year. Like I said, part of that BRAVE acronym. I'm not changing my thoughts on that. Bitcoin arguably better simply because we have a regulatory framework that's going to appear a lot more accommodating net of Trump's victory. But still, why would we be opposed to gold and also silver, by the way, today? I'm not really. Okay, so put spread, yeah. So the 565.20 in SPY and the 5600, 5400 in SPX. Yeah, these things are definitely going to have gotten hit. But if you are going to go and try to adjust your hedges, I think that put spreads make sense. And they're going to be a lot cheaper today. They're just going to be a lot cheaper. The at-the-money vols have come way in. And you don't need to have just the 30 delta. One of the reasons I like 30 delta puts was because that you have the ability, you're much more nimble with a 30 delta put in the sense that if we get some cataclysm, you want to roll it, you can do that. The thing is that we don't have that obvious catalyst that's so cataclysmic. It might be that investors begin to say, whoa, we're kind of getting into nosebleed territory here in terms of valuations. Maybe we get some economic data that shakes their confidence a little bit. The Fed makes some comments that catches people out a little bit. But the fact is that those kinds of things are more likely to cause pullbacks, but not some disastrous correction. Not to say that a geopolitical event couldn't do that. That's still possible. But the other thing is, aren't we probably going to be a little bit on pause until the inauguration at least? And this is seasonally a pretty good time going into Christmas and New Year's for markets. So we have a huge potential market-shaking event that investors appear to believe is all to the good. So yeah, I mean, I think put spreads is probably all the hedge you need at this point. We should watch. I will say this: listen very carefully to Trump and the people that surround him, just for anything that might sound a little bit out there in terms of ideas. I'm really hope that they strike a conciliatory tone. I'm hoping that they reach out to their opponents, and I hope that they embark on practical solutions to the largest problems and don't get petty and caught up in other nonsense. If we see that obviously introduces additional risk, right? So do you think 25 or 50 basis point rate cut? I think 25 probably is the rate cut we're going to get, although there was one or two calls for it to be larger. Maybe we could get a 50 basis point rate cut, but I think I've previously said that when you're dealing with rates, so let's get the Fed target rate in here. Let's see. Oops. This is our rates page. And, the thing is that if you move a 5%, call it 5%-ish rate by 50 basis points or 25 basis points, it's not going to be a huge thing one way or the other. So just give it some perspective right here. So we get a 25 basis point cut. That's going to take us down to here. We got a 50 basis point cut that takes us to here. This is the context going back the last 30 years, right? So does it matter? Yeah, of course it matters on a signaling basis, but is it hugely meaningful whether it's 25 or 50? I don't really think it is. There's a benefit to each. A 50 basis point move looks more decisive. So that's the positive side. A 50 basis point move also looks like, the Fed thinks that a larger rate cut is needed, right? So, and if we take these things, I actually kind of think they sort of balance out, which is part of the reason why I don't know that it's going to make a huge difference. I would say, though, that if they hold things steady, and they do so because they are concerned about inflationary pressures, that could be a problem. So we don't want to see that. As much, and I'm actually, what's interesting is that on my TLT trade and my long-term rate bet, and the fact that I'm betting on steepening, I'm saying that over the course of time, growth, debts, deficits, all of these things are inflationary. And so you have a combination of inflationary things and growth things. Long-term rates go up. So you could see the Fed saying, okay, well, if we're going to get a whole lot more of that could rein them in. So that I think would be an issue. So I guess as a market bull, you have to hope that you do still get a cut of some kind. All right. So already addressed the question of, have we seen anything like this? What do you make of future long bond prospects, Fed quantitative easing, and how this weighs on equities? I think I addressed that, Steve. And Sem, like I said, Sem Carson, smart guy. this is his area. This is both of their areas, right? So those guys have lived. It says SIBO on the back. That used to be CME. So those exchanges have essentially become the same thing. But so what they were saying is that higher growth, higher inflation, higher long rates. So that's at a high level. Let's start with that. Higher long rates, lower short rates. That increases the steepness of the curve. And actually, why am I saying it instead of just showing you? We can go back to this other page, and let me see. I think there's something I can just quickly click on here. Where's my rate curve function? So here we are. So you can sort of see where the rate curve is. You can see it's quite flat. And as everybody knows, it was inverted, right? So that was the big thing that everybody was concerned about, is that we had the inverted yield curve. So that means that the short rates were trading over the long ones. Why is that bad? Well, short rates are high. It's restricting money. They are high because you have inflation, and the long rates are low because you don't have much growth expectation, even net of inflation. So a healthier environment, a normalized rate curve, and steepening is good. I will add one other thing, which is that historically, when we had circumstances where an inverted yield curve precipitated a recession, that the recession often did not emerge until the yield curve normalized. And now we're in that reality. So that steepening where the long end comes up and the short end comes down, we're in a kind of a vulnerable spot for that reason. So we have to sort of monitor, if you will, the economic data just a little bit more closely than you do most of the time, because that's sort of the confluence of events that you really don't want to see. Everyone's saying soft landing. It looks like everything's great, but we're always looking a little bit out of the rearview mirror when we look at economic data, right? So if the yield curve normalizes and then we start getting some just trailing data that is maybe not as good, we start seeing some negative revisions, those are the kinds of things that would be, some cause for concern. But right now, I have to admit, we are not really seeing it. So that is that. Let's see. Thoughts on airlines, United Airlines. Your opening put spreads on United has had quite a run, right? So this is an interesting one for me because, and I've mentioned this before, that I actually thought United was quite attractive relative to Delta, and Delta is always the one that my colleagues on CNBC seem to favor most. Does have a couple things going in his favor. I've mentioned before that they own their own refinery, for example, so maybe less vulnerability on the fuel cost side, which is always a big cost. Their big costs are labor, fuel, and of course the planes themselves. It has grossly outperformed Delta off of these lows. I mean, the thing is up more than 100% just since August. I think we'll see. Was that double the performance of Delta over the same period of time? I think it's something like that. Yeah. So what was that? Like the second week of August? We'll do that. But neither of these companies is particularly expensive. I just want to make that quick point. Yeah. So what did I say? Double. It is double. 125 versus 63. It's basically spot on 2x. But United isn't massively expensive even now. It does get to a point, though, that if you've been in a spot good enough to have ridden it up here, maybe you take a little bit off the table, do a little bit of a reval. But it's still not hugely expensive. I mean, we've got $12.30 adjusted, estimated for next year. So 7 times. That's not huge, right? 7 times forward earnings. But more economically sensitive. That's worth a point. But if you believe that it's gotten extended just from a technical standpoint, then yes, put spreads would absolutely be the way to play it. And actually, to that point, why don't we just take a look at what the technicals have to say and see how many favor taking it. It's almost 50-50, but yeah, the RSI definitely on the high side. So you can see here Ignore, as I always say, ignore this buy and hold. Doesn't really count for anything because that's just there as a placeholder, so you can compare it to what a long equity position would be. So there are still quite a number of bullish indicators that would maintain longs, but things like Bollinger's and RSI, the moving average oscillator, those things are suggesting that this one's getting a little extended, or a lot. It's getting right up there. It's been extended for some time though, so you can kind of see here that you have to be it's very tricky to make your short bets based on something like this because things can blow out, really catch fire, and that can last a while. I mean, it first ticked into the overbought condition officially if you were using these parameters on the 14-day back in mid-September, and the stock was it's risen 80% since then. So one thing you might want to think about doing is just wait for some kind of a little bit of weakness to press the shorts on something like this. I mean, we have a big unfilled gap here. Probably going to broach this thing sooner or later. But how much nicer would it be if we get another gap open higher and then it ends up closing a little? So let me give you a scenario where I would say, okay, I'd want to lean in on the short side. Stock's 87.60 here, and it opens up tomorrow. We'll call it at $89 the figure, trades to 90.5, and closes at 86.5. So when I was on the commodity floor, that was basically the most bearish thing you could get. Almost didn't care what the underlying was if you got something like that. So those downside reversal days, that was the one thing I kind of felt like if you're looking for anything in a fast rising asset to say, wait a minute, too much, that's it. So you're not going to top tick it, but you're also not going to sell it here or here or here or there and so on. That's my own 2 cents. Of course, bear in mind that I come at this from a largely long perspective, right? Because asset prices generally rise over time. The value of a dollar falls over time. The economy grows over time. So when you take all of those things in, darts at a board, it's better to be long. But if you're looking for a place to get short, I think, and the other thing is that's a self-fulfilling prophecy because I'm not even a technical analyst, but that's a technical signal that I look at just like everybody else I know. It's kind of one of those universals. You could be a private equity guy. You see a pattern like that. You're like, okay, I don't know what's going on. I don't want to know. I don't want anything to do with it at that point. So just, let's see, where are we? Oh, I've chewed up an hour already. How about that? Okay. So, this is, it's an interesting day. And these are interesting times. I'm going to assume not everybody watching this is either a Democrat or a Republican, and probably few of you are registered to vote as independents. No affiliation, as I am. One of the reasons that I don't have a party affiliation is because tribalism really bugs me. That's not a reason. If you are an investor, the last thing on earth you want to do is make your determinations based on what group you're a part of. That doesn't make any sense. Like, you just have to take a look at the data, look at the ideas, and try to pick the best ones. But I completely understand why people would be, and you don't make it anywhere. If you have aspirations of political influence, you're not going to get anywhere as an independent anyway, unless I suppose you're Bernie Sanders. But I will say this, and I guess this is a message to any Democrats, registered Democrats, and that is that I hope there is some introspection going on right now. Don't focus on the people, focus on what matters to them. It is really clear that the electorate was badly hurt by rising prices. Inflation has fallen, that's all, but prices are largely 20% plus higher than they were 4 years ago. And that has hurt a lot of people. It's hurt everybody. It's hurt us. I'm sure it's hurt everybody who's watching this. You know, you go to the grocery store and a dozen eggs, you know, it depends where you live, but at one point a dozen eggs was like $12, $1 an egg. Like, come on, who are you kidding? I went and bought some coffee. I bought a latte, a drip coffee, a bag of coffee, a scone, and a croissant at a coffee shop here where we live yesterday. It was $54. $54 for a bag of coffee, 2 pastries, and 2 coffees. Let that sink in. You have something like that, and the electorate's going to get upset. If you have a border that looks like there is no border, people are going to get upset. And actually, I think Biden and Harris, they took heat for some things that they weren't entirely responsible for either. So, I live outside of San Francisco, and we had big upticks in crime. We had prolonged shutdowns here. That's a function of the state and the city more than it is what's going on in Washington. But there was a sense that they weren't doing things right, that things were getting distinctly worse. And a good friend of mine, a very successful investment manager who's based in Los Angeles, I've known basically my entire adult life. One of the things that he said to me when we spoke this morning about the results of the election, and it makes exceptionally good sense, is there any Democrat who could say, here are the things that I like about Trump's policy ideas, and started their conversation competing with him with that? That, first of all, that finds common ground with the electorate in all cases. Tucker D. Dog, not getting your coffee at Dutch Brothers, apparently. I don't think there is a Dutch Brothers around here. That was from Equator, by the way, which is a regional coffee thing. Equator Coffee is here in Marin. But, for those who are Democrats, if you have any people in your sphere who are in the political world, start with that. It does no good whatsoever for two halves of the country to think that the other half is either deranged or evil, because they're not. Most people are just trying to do the best that they can. At least they think they are. They're not malevolent. These people aren't going and hanging upside down and sucking blood in the middle of the night. I don't care which side of the aisle you're on. So that's those are kind of my final thoughts, because I hear, there's some crowing and people pleased with the results, and there are others that are despairing. But how about just being practical for a moment? And that's what I hope people will do. So we're going to have another one of these live streams next week, Monday, 4:15 Eastern Time. And think about anything that you want us to discuss at that time. Put it into, not the live chat, but just comment under this video, and we'll look for it. And I'm going to think about it too. I'm still trying to digest, just like you guys are, everything that happened. And we'll have a lot to talk about, I'm sure of that. And I look forward to doing it. I'll see you next time. Thanks for watching.